When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how are you doing this fine last Saturday of September?
Oh, I'm doing great. How are you doing?
I'm doing great, thank you. Football season in full swing. There's a lot to talk about on today's show. But before we get to the dollars and cents of stuff, I've been hearing from football fans, Kansas City Chief fans, Travis Kelce's off to a little bit of a slow start. And they're saying it's because of his acting career or Taylor Swift.
Jeez,
I think he's a little distracted. What do you think? Or is this just the up and down of a professional athlete?
I don't know. And I'm a really Andy Reid fan. I don't care much for his team, however. I love what he does with football teams. I love what he did out when he was with the Eagles. Actually, he's a BYU guy like me. So, we go back a long ways. But anyway, I don't know. I think the refs coddle that whole team. I think Mahomes gets more credit than he deserves, even though he's a great quarterback. Kelce, I think when they have a team that when the line's popping and Mahomes isn't running for his life, Kelce can get open and get some balls. But, I think the team's a little bit under, just under their normal performance levels. And they're getting helped a little bit by referees. I think that's a pretty well-known fact if you just look at things. But anyway, I don't like to be – I'm not a conspiracy theorist. I think they just maybe – it's kind of like when you're a superstar, like, LeBron James, that guy, makes probably 30 fouls a game and doesn't get called for 3, So, they kind of give you a pass when you're in that elite status. And I think because Super Bowls and, Andy Reid's and Mahomes and all these people that, and Kelce, who are, these superstars, they kind of get a little pass. But, it's too bad that he's probably so distracted with Taylor Swift and making millions and getting a $100 million podcast contract. I mean, he doesn't even need to make money playing football anymore.
No.
Especially if, he goes off and marries Taylor Swift and has some prenup where she only gives him $500 million if they ever break up. But no, I don't know. There's part of me that thinks this whole thing was contrived, staged, and just part of the big old, money game to make both of them a little bit more popular and kind of advance both of their careers. But, I assume that they'll probably break up soon, and she'll write a few great songs, and he'll be entitled to some royalties from all the songs about him.
Well, that's what she does. She writes songs about people that she's broken up with, but nevertheless, certainly I think it's brought a lot of Swifties into the Kansas City Chiefs camp and made them even more popular. But I think that Kansas City Chiefs are America's team these days. I think they've replaced the Dallas Cowboys, but that's neither here nor there.
Anybody could replace Dallas Cowboys. We go there, but I think they are. They're heartland of America. They're trying to get a three-peat. Nobody's ever done that, and I think that's kind of what the league's trying to hope for, and maybe they're kind of positioning it for that. But Kelce's got to do his part. If he wants to stay on the team and continue to be a Hall of Fame football player candidate, he's got to finish strong. He can't just go off with Taylor Swift and do his podcast forever. He's got to pick it up and catch some balls and get open.
Yeah, you got to realize what your priorities are and what you're really being paid for. A great time for sports this time of the year, though, with football. Mm-hmm. We've got, of course, postseason baseball coming up. We have college football, basketball around the corner. But that's not what we're here to talk about. We're here to talk about your finances, your journey towards a prosperous retirement. But we can't do the show here without talking about the most recent development. Well, it's not that recent now. It's been a week and a half or so, something like that. But that is the Fed rate cut, 50 basis points. So what's next for the markets and the economy after this Fed rate cut, Jeff?
Well, let's just first of all clarify, markets and the economy do not go hand in hand. I mean, our economy has been slipping into bad news, for several years. I mean, the labor market is weaker than it's been since 2016, based on the latest stats. Consumer confidence is now down below, I believe it's below the 100 number, which they expected a number of 104, which, it's all relative to what the other numbers are, but it hasn't been below 100. It came in at like 98 on Tuesday or Wednesday this last week. And, Yeah, that means consumer confidence is waning a little bit. I think the consumer is seeing some of the gamesmanship that's being played with the market, some of the lies that are being told by everybody from politicians to banks to brokerage firms to everybody else. But the economy, economic indicators are down, production, manufacturing is down, unemployment is up. The only reason the Fed ever lowers interest rates is to avert a recession or to react after a recession starts. And if you look at all the economic factors that indicate recession, we're kind of starting there, and so is the rest of the world. But we've got a big economic slowdown. They're failing to admit it. There's only been one time in history where there's even been a soft landing. Every landing's been more of a hard landing, and I think that's been in the last 70 years since they've been tracking the recessions in the markets and things like that. So I think that so many governments, including China this week, just did a stimulus package and boosted its market, even though the economy is slipping very badly. America's economy is stinking it up, but they don't want to rock the boat with the election coming up, so they want to make sure Harris still can carry on whatever legacy they believe is worth carrying on. Certainly hasn't helped the middle class the last 4 years, but that's supposedly her stance is, we got to do this for the middle class and make the middle class great and opportunity economy and all this stuff. Well, where's the last 4 years? What opportunities? It's everything costs more, interest rates are higher. They did so much stimulus that it came back to only pad the pocketbooks of the rich people and the big businesses, and ended up hurting the average consumer, the middle class person. Totally the opposite of what's being preached. But of course, whatever the news says, everybody just believes, because we've all become, well, not we in our generation, but people younger, our kids and their kids are just kind of lemmings going, oh, well, they said it on TV, or, oh, I saw it on Instagram, must be true. And just believe all this propaganda and BS that they're throwing so much money at Harris, and they're throwing so much money at the market. There's we call it the plunger team on, I guess White House kind of manages it to manipulate the market. And they basically say they'll buy up stock futures to make it look like the market is strong. And then we've got so many households that have money in stock market. 65% of household assets are now in stocks, which is like close, if not at an all-time high as far as the percentage-wise goes. And when households own that much in stock, when they're so overly excited about the stock market, anytime that it's in the 60% range or higher, we've had a recession following, we've had a big sell-off following, and that's usually because the institutions have already gotten out of the market. So, we've been seeing, these things starting to happen. I think a lot of people don't believe it. I mentioned I think it was last week on the show, that more than 70% of NVIDIA buyers, retail buyers, the people that own it right now, bought it higher than it's at right now. And I saw a number that was 72% were at a loss, while that was a day when the stock was 117. That's on NVIDIA. NVIDIA is like the darling of Wall Street, manipulating the market up and down based on what NVIDIA does. The market seems to follow. And, the company can do its own stock buybacks. Banks can get all that free Fed money given to them because, they're having loan default. So the Fed's loaning them money for the bank term funding program a year and a half ago that didn't get paid back in March like it was supposed to. So the banks have all this extra money, and they're manipulating the stock market by buying their own stock, by buying NVIDIA and some of these other high flyers that generate movement in the market, and really kind of leave the rest of us who, kind of grew up looking at fundamentals and have a finance degree and a business degree and, I understand how business is supposed to work. Fundamentals have been pretty much absent the last few years, and it's frustrating for a guy like me and probably a lot of people that, aren't day traders, but more long-term, trend investors, is the trend should not be where it is. We had a big old 50% rate cut, which is the biggest of its kind in how many years? I don't remember, but typically they're 25% cuts at a time, not 50 all at one. And that usually indicates there's it's to avert recession. And so we're typically already, by the time the Fed reacts, we're typically already going downhill. And the stats I mentioned earlier, pretty much confirm that. But that doesn't mean the market's going to necessarily crash. But it does mean that the market's at increasingly higher and higher risk because there's more and more fundamental reasons for the market not to go up. For the last 2.5 years, we've been, claiming there's going to be rate cuts, going to be rate cuts, going to be rate cuts. Remember, they had actually it was October a year or 2 years ago, I can't remember, but they're talking, we're going to finally have some rate cuts. And they priced in between every bank priced in about 5 to 7 rate cuts from the 5.5. That was 25. You take that we're under 4% rates, and they just assume that because of that rate cut of 5 to 7 times, that if interest rates go down by a 20% level from let's say 5 to 4, that's basically 25% rate cut, that earnings should go up 25%. Well, that's not true. but they're pricing in like earnings growth of 25% a year. Well, last year we had earnings growth of barely 1% on the S&P 500, even though the S&P 500 grew at 30 or 40% or something stupid. Just big numbers. But of course it was down the year before because there was no actually negative earnings. We still haven't seen those earnings come back. They've been priced in. The rate cut has been priced in. And now, they've been talking about rate cuts again for the next few years. So this 50% rate cut has been priced in like 3 or 4 times since the original rate cut. So, where the stock market is right now, rates ought to be around 3% and earnings should be growing at, 10 to 20% on the S&P. Well, they're not. Earnings aren't growing on the S&P. The only reason earnings are growing at all is because big companies like, Facebook, Amazon, Spotify, UPS, and all these other big companies that come to mind over the last year have laid off tens of thousands of people. Now Boeing's on strike. You've got all kinds of things that are really not positive for the economy, yet can kind of fake earnings and fake a look that makes the market somehow look strong. Yet it's really just the rich getting richer and the banks and the brokerage firms manipulating the market, and they're unloading stock at unprecedented profits to the unsuspecting, lemming household buyer that just says, well, the market's going up, we got to jump in there. Well, you know what? That might be good if you've got a long-term outlook. But if you're living on that money, you've got to consider risk. And, we are a safe money guy. And so we have missed out on some of this upside. But this upside's fake. It's just contrived, and it's hype, AI hype. It's, I guess you could follow the money and, hopefully somehow time the market before the money starts to sell off and you lose big. But, I don't think that's wise, again, if you're trying to retire and save your money. So we look at this market. Sometimes I think we get this feeling of, boy, we're missing out. Boy, they're doing all the right things. Well, are they doing the right things? 50% rate cut, maybe a little bit too late. But the thing is inflation still isn't under control. You know what the rate cuts do? It creates more liquidity. And if things work out like history says, we're going to have a big wave of inflation. Of course, it'll be after the election, after they put whoever they want back in office and or keep the regime in power, which is what they're trying to do. It's obvious. And if that happens, then we're going to have this big round of inflation again, where the middle class will be beaten down even more. So, it's hard not to get a little bit political, but political policies, policies of whoever's in leadership do definitely make a difference in the market. But then again, as long as they keep creating liquidity and not holding the banks responsible for their own, bad loans and use taxpayer money to prop the market up, we're going to see the market go up. Can we expect that forever? I don't know. Price earnings ratios right now, if you look at the Shiller price earnings, it's basically an adjusted, current adjusted price earnings ratio, not what they think the future earnings are going to be. It's actually what the company's earning right now. It's like in the high 30s. It's only been that high one time, like in the 2000, right before the 2000 crash. Every time it gets this high, we look at kind of a lost decade where the market kind of has to go through some, gyrations of ups and downs and choppiness before you come out 10 years from now with some sort of a reasonable rate of return around zero, which is, based on history, buying in at the market when it's priced this rich typically doesn't bode well for the next 10 years. And you can see a chart, it follows very consistently to a look back 10 years ago. What was the price earnings ratio? Well, what was the earnings rate, for the next 10 years? Well, there's a correlation, and there's a chart that has several cycles that we can look at. And if history repeats, the market will end up winning, even though they're pushing and pushing and pushing hard to manipulate the market. The next 10 years historically should be somewhere between about negative 3% and plus 1.8% of annualized rates of return, which means we could be looking at another lost decade. That of course is if history repeats. Will it be different this time? Well, Templeton said, the Templeton Funds fame back in the 70s said, I believe it was the 70s when he said, the most dangerous words that you can ever utter in the market is this time is different, because the cycles always end up repeating and they never end up different. They claim that this is going to be a different, I'd like to see it different. I'd like to see us never have a recession. I'd like to be confident enough to go in the market and just continue to overpay for stocks and have them continue to go up. But I'm a little worried about that, especially if we have to make, a certain nest egg for retirement last 20 or 30 years. We can't afford a lost decade. We can't afford zero returns. We can't afford, losing 20 or 30% in the next market sell-off, while we're spending money because we lock in losses and things like that. So I don't know. Again, a very long answer for a very short question, but hope that took care of the original question. And we got plenty more where that came from.
That's right. We're talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our telephone number, 520-780-9059, if you'd like to get in and sit down and talk with Jeff about this rate cut and how it will affect you and your journey towards a confident retirement. Once again, 520-780-9059. Make that call this weekend. Jeff, I think a lot of people thought that when we got these rate cuts that things were going to be instantly changing, that the next day that things were going to be a lot cheaper insofar as buying things go, and that there were going to be these big differences, but that's not the reality of it. From an investor standpoint and from the standpoint of someone who is buying something, what do these rate cuts really mean here in the short term?
Well, I think in the short term, all it means is the Fed's changed their policy and are getting a little bit more dovish on the policy of keeping interest rates high. They realize that people aren't buying as much stuff, that prices are stabilizing, which is good. I mean, they're still growing. I mean, we still have inflation at close to 3%. It's not like we are back to zero and just kind of holding our own yet. Prices are still going up. So even with a small decrease of 0.5%, which is only 10% of the interest that you would have paid. So in other words, if you bought a car and your interest payment was $300, now your interest is only $270 a month. But there's the same amount of interest on that. I shouldn't say that. That'd be like more of a house interest. But let's say it's $100. So now it's $90. So you're only saving like $10 on your car payment just because interest rates went down 0.5%.
Right.
Is that really that big a deal? Well, all it does is it probably justifies the car dealership. Hey, but we got lower interest rates, so you can afford more cars, so we don't have to give you rebates now, or we don't have to buy down your loan rate, or, now we can make more money on the loans. I just bought a truck, and interestingly enough, and they kept trying to, brag that, they get down around 6% with my great credit on a car. And I said, well, and, of course, they make a little participation. Knowing that interest rates are going to go down, they could sell that loan, to an investment bank and make some money. Well, they ended up, I think they assumed that I was going to be financing the car, and it was a pretty nice truck. Anyway, it was close to six figures. So anyway, I mean, they thought they were going to get this big fat loan, and I wrote a check. So, and they go like, wait, we just gave you that car at invoice. So they actually did lower the price, but they were making a lot of money on the financing. They're going to make less money on the financing. Guess what?
Yeah.
They're not going to be lowering prices anymore. Shoot, it was a year ago. People were willing to pay $10,000 over invoice or over MSRP, not over invoice, or $20,000 over invoice for that same truck. And so there has been a little bit of price, of friendly pricing that, things are starting to come down to normal, because less people are being able to afford it. And the fact that prices have starting to come down on things, or at least be stabilizing, especially in those high-end discretionary items that most people really don't buy when they're hurting financially, aren't going to go out and, they can't afford to finance them either. And if they could, they could have bought them at the higher rate probably. So, I think there's going to be, in some areas, there's going to be some, price retraction a little bit. I don't think a little bit of a rate decrease is going to be a big deal until rates get down to maybe the 2 to 3 or 4% again. That's including mortgage rates, which are still, I think, in the 6 range. So, and until prices come down, higher interest rates are still going to be a problem. If interest rates come down, then it's going to justify continuing to charge more for, cars and houses and some of those big ticket items that typically are financed. There's a big range of what people think that the interest rates are going to end at. The short-term interest rate went from 5.25, 5.5 down to 4.75, 5-ish. And they're thinking, over the next year and a half, we should be somewhere between the range of 2 to 4.5%. That's a pretty wide range. This is different banks and, economists that are suggesting, well, they could be 2% by the end of next year. And some people say, well, I think they'll stick around 4.5. It'll be enough. And, I think 4.5 is actually the healthier level. And the reason I say that is because it still creates less of a push for that next wave of huge inflation. If we go down to 2%, oh my gosh, we're going to have inflation rampant again all over the place. It's going to make a few people, think they can get into a house and in a car. But, now what? The inflation goes back to where, we got another 20%, 30% increase on food prices and gas prices over the next year or two. So, we don't want that either. So, the Fed has a really hard job. They let us get into too much trouble, way too much quantitative easing in the first place. The supply chain disruption is definitely going to exacerbate that problem. It was a problem that was probably going to happen over time anyway. It could have happened gradually, but it didn't. It happened very quickly with the COVID program, where they shut down the economy, supply chain ended, and now all of a sudden there's all this extra liquidity, less products, and so prices just started going up. And now they pretty much stayed up. It's not like they're going backwards. I don't know. I think there's still a lot to be seen of what happens the next year and a half. I think most everybody who's a noted economist or somebody who understands markets and been around for a while knows that we are either in a recession or going to have the evidence of a recession and some sort of a market correction within the next year or so. Now, I've been saying that for more than a year, and I still think it is logical that it should happen just based on the data that we see, based on history that we've seen. But yeah, they're pretty good at finding ways to kick the can down the road. Do we just believe they can do that forever and jump back in the market? I just think it's, still priced way too high at this point. And I think there'll come a time when it makes more sense, but it's not right now.
Jeff, I know you don't have a crystal ball. Nobody can forecast the future, but what are you hearing as far as further interest rate cuts this year and on into the next year, and where's it going to end?
Well, I mean, if you look at what, Fed fund futures recently have implied about a 2% rate decrease. That's on the short-term rates. So in other words, from around 5 down to maybe 3-ish. That would stand to reason. If you look at currently, the 10-year Treasury is trading at about 3.7. It was down to about 3.6 about a week ago or so. And then it kind of popped up after the Fed lowered interest rates, interestingly enough. But there's going to come a time when, that short-term interest rate is actually less than a 10-year, less than a 2-year, less than a 20-year, and so forth. And right now, there's still all the other ones are kind of in the high threes. The 2-year and the 20-year. And the 2-year and the 10-year are all kind of in that same ballpark area. So we have that inverted yield curve uninverting. Typically, as the yield curves, that anytime there's a yield curve inversion, I've mentioned this several times, and it uninverts, that's typically the start of a new recession period. Now, I know they're trying to, back in the 90s, in the mid-90s, Greenspan somehow engineered, and I think a lot of that was bolstered by the really good economic tech climate that we were in with the internet and all that. I don't know that AI is quite the same, but they're trying to engineer it kind of like that soft landing that we had. In 75 years, there's only been one time that these conditions exist that are in existence right now, where where we've actually had a soft landing, not a hard landing or not a big correction or not an economic, I don't want to say disaster, but a tough economic period of time. Definitely, recession, and some have been harder than others, but there's only one that would be considered a soft landing. There's never been a time when there was no landing of any outcome based on where we're at right now. The other thing is the recessions always start after the first rate cut. So we've still got, some of those things to look at. And if that happens, they might actually, and that's why some people are, claiming there might be 2 or 3% of rate cuts over the next year, because if we do slide into that recession that, would be predicted historically and based on the conditions that we, look at, the economic conditions, then they might be a little bit over exuberant on the rate decreases, which would again result in, even higher inflation as we rebound and come out of the recession. I think engineering a soft landing is going to be tough. I don't think it's impossible. I hope I would rather have a soft landing than a hard landing. However, a hard landing, if it does result in, market correcting, down to where it's at fair value or reasonable value, where the price earnings ratios are in range to where it looks like it's a really smart time to buy, because the next 10 years would have an average rate of return, back up in that 10 range, which is what, we kind of like in the stock market for our risk money. But we want it to be less risky. And the only time you get it less risky is when you buy correctly. When you can buy investments that are great long term, but you have to buy them right. You can't buy them at the highs. And we've been at the highs. We've been keep making new highs for the last year or so. There's going to come a time when, earnings and pricing suggest a much wiser time to buy with, future earnings, better opportunities and better probabilities. So anyway, there's a wide range of outcomes. Everybody has a different idea. I think there'll probably be a few more rate cuts just because, we started down this path. I think the economic truth will become manifest after the election. I think people will look at it a little bit more seriously, and fundamentals might actually start creeping into the equation, now that they're not just trying to manipulate things for an election. So yeah, we'll see what happens. It's always, we can follow the money. And right now, smart money's getting out of the market. Government money and manipulation money is what's driving it right now. So I'm a little bit nervous to follow the government money. I'd rather follow smart investors like Warren Buffett, who's got about $275 billion raised in cash. Gundlach, who's only buying bonds and gold. Some of these big hedge fund managers that are divesting their investments in the equities and going more to safe and cash because, they're looking for a better time to buy in the future. And we want to be on the side of smart people, not the side of the lemmings that just follow whatever they're being told on TV.
Our program is called Premier Retirement. We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about the Fed rate cuts and what it means to you. You're listening to the program today. You have questions about what's going to be happening in the future as far as the Fed rate cuts and how it affects you. We invite you to give us a call here at Premier Retirement. Our telephone number, 520-780-9059. Leave your name and telephone number. Shelley will call you back during the week and set up an appointment for you to come in and sit down and talk with Jeff on a one-on-one basis. Again, no cost, no obligation for this. 520-780-9059. Absolutely no obligation whatsoever. 520-780-9059. You can find out more about us online at premret.com, premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll answer listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us each and every week for Premier Retirement here on 790 KNST, Tucson's most stimulating talk. You're hearing us on the radio today. Well, we're on 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. And as always, you can hear us on your schedule if you want by going to wherever you get your podcast, searching for Premier Retirement with Jeff Hogan. You'll find this show and many, many of our past shows so you can stay on top of your journey towards a confident retirement. Jeff, time for listener questions. Dan's listening to us in South Tucson. Dan writes, I'm 66, my wife is 64. I plan to retire next summer at my full retirement age. My wife will continue working 2 more years till her full retirement age. Our combined Social Security income will be about $6,000 a month. We have $65,000 left on our mortgage. Our monthly expenses are $8,500. We have about $600,000 combined in our 401ks. If we roll that out, what is a realistic rate of return that we can expect on our money with low to moderate risk?
Well, that's a lot of good questions right there. You've obviously saved. You've got your mortgage almost paid down. That means you're going to lose some of that cash flow out expenses. Combined Social Security income is pretty nice, especially if your expenses are about $8,500. You get rid of that mortgage, and I'm not saying necessarily that you should. It's certainly. And by the way, I'm going to talk about mortgages. I don't think if you've got a mortgage at 2 or 3%, you should be able to make more than that on your 401k money. So if you're making more than 2 or 3% on other money, don't go paying it off. And if you do pay it off, definitely don't pay it off by taking a lump sum out of your 401k, paying taxes on the $65,000, which will cost you $20,000 or more, just in order to get rid of that cash flow issue. The money you take out of that, the $85,000 or $90,000 it'll cost you out of your 401k, could generate enough money, long term to more than overcome the interest you're paying on that mortgage. So I'm not a proponent of necessarily paying off the mortgage, but you just said it's pretty much gone. So, why not worry? That's going to be gone pretty soon. A realistic rate of return, in my opinion, should be 4 to 6% on something, kind of conservative and moderate, not super aggressive. I don't think you're in a position, with the fact that you need an extra $2,000 or $3,000 a month. If your expenses are $8,500, I don't know if that includes taxes or not, but you should be making maybe at least $120 a year. So if you've got $6,000 a month, $72,000 coming in from Social Security, and let's say $60,000 of that's taxed because 85% of it will be taxable at your income bracket, and then that $600,000 needs to come up with the other $40,000 a year. I think that might be a little aggressive if you want to use stock market type investments as far as the expectation goes. Now, the good thing about that expectation, and that is that, there's an old rule of thumb called the 4% rule, which says, even though stock market averages 10 and the bond market averages 4 or 5, over the long haul, if you have a 60-40 split between stocks and bonds, you should, be comfortable taking 4% of that money out. That means $24,000 a year in order not to run out of money in 25 years. Well, first of all, you're pretty young, and, 25 years only gets you to about 90. That might not be long enough if you're like many people I know and many clients I have that are well into their 90s and pushing 100. Some even make it past that. So, I think you might want a little bit more of a conservative approach for income, and especially if you really want to live on that $8,500 net, consider putting $400,000 or $500,000 of that $600,000 into something that might average that, 6% rate of return, but not have any principal risk. And if it does, insurance companies who manage tons of pensions can basically set a pension up for you, essentially, or you still control the balance of your account. It's not like you hand it off to them like these old school annuities where you give it to an insurance company, they pay you till you die, and if you don't use up the whole 400,000 or 500,000 you put in it, you lose the rest of it, and they use that to pay the people that live too long at the expense of the people that don't live long enough, right? So what if you could keep the whole, let's just say $500,000, and let's say at your age it would pay you a payout of $30,000. Well, you get pretty dang close to, what that necessary income is, and that's guaranteed for life. And that would actually come out higher than the 24% rule on the entire $600,000. Then you've got another $100,000 that you could invest in, even short-term interest CD rates or whatever that you can have for liquid money to invest in those emergency things that come up or take a trip here and there or whatever. So, I think there is a way to be a little bit more aggressive on the income level by being more conservative on your investment level. Otherwise, I'm not sure, again, based on if this is net taxable or not. And I don't know if you have anything other than your 401k to live on, but you definitely need to make up that there is a gap between what your Social Security income is and what you have in monthly expenses. I don't know if that includes a lot of discretionary items like travel and fun and nights out and, emergencies and things like that might come up. You might want to consider that in your budget as well. But, the other thing that I will mention, and I'm not opposed to, in fact, you find more rich people are using this strategy than you'd think. That is reverse mortgage. I don't know how much your house is worth, but obviously it's worth more than $65,000, probably worth, $500,000 or more. You can always use that equity and live on that should you need it. If you don't want to, scrimp and, not, change up your lifestyle. So keep that in mind. That equity that you have in your home is an investment, and it can be made liquid either through home equity lines of credit or what I like is the reverse mortgage that actually offers a home equity line of credit that, if you take it out now with the interest rates as high as they are, they actually have a line of credit that will continue to grow at, let's say, 6% or so, even if you don't use it. So you have this ever growing credit line that you can use and tap into. And every time you do so, that money is tax free because it's a loan against the equity in your home. When you die, whatever equity is left in your home still goes to your heirs, just like it would otherwise. But you have access to it through equity lines of credit, some of the creative tax-free type of planning that you might want to look at to enhance your income needs and just your peace of mind going through retirement.
Dan, thanks for that question. Of course, we'll be sending you out Jeff's book, Retirement, The Road Ahead. And again, our telephone number, 520-780-9059, if you want to get in and sit down and talk to Jeff on a one-on-one basis. No cost, no obligation for that, Dan. And thank you for listening to us in South Tucson. Michael's in Sahuarita. Michael says, I'm 67 and retired. My wife is a big believer in holding a balanced fund with a mix of stocks and bonds. I agree this is easy and effective during the accumulation phase. Now that I've shifted to the distribution phase, I want growth in income assets in totally separate funds. What are your thoughts on this strategy?
Well, if you've listened to my radio show a while, you know my thoughts already. And Michael, you and I are both going to not be big fans for your wife. I mean, obviously, she's not going to be a good fan of us. I agree with you. I think growth and income need to be totally in separate funds. Growth funds are aggressive. Growth funds have opportunity for loss, probability of loss. I mean, because they do go through growth and loss phases. That is a great strategy, a balanced fund. In fact, I think even more aggressive than a balanced fund with a mix of stocks and bonds for growth during the accumulation phase would have been fine. I don't think you need any bonds during the accumulation phase. I think you should go all in aggressive and dollar cost average in and just know you're not going to touch that money. When you get about 10 years from retirement, now you're already past that. You're probably at retired. So, because you're already retired, you've kind of passed that point of, why would you still be in a balanced mix of stocks and bonds? If you want to do asset preservation, which we preach, is just, hey, you work really hard for that money. How much of that, let's say $1 million or whatever it is, do you need to set aside to fill the gap between Social Security, pensions, and what income you want to live on or you think you need in order to, pay your bills, have some discretionary income, and have a little buffer for those unexpected expenses every month? Well, if it turns out that there's, $600,000 could buy you, an extra $3,000 a month, which covers the gap, and there's still $300,000 or $400,000 left in retirement funds, put them in growth or put them in a balanced fund, a mix of growth stocks and bonds that, you can kind of wait on and not have to use if the market's bad, or that you can, take advantage of some good growth opportunities when AI gets to be hot or whatever, or the new, .com era comes back. whatever the next phase is. But, it could be energy, it could be who knows what, gold, silver. It's kind of nice to be able to diversify and go into those type of investments that, have the opportunity to pop and give you some nice returns once in a while, keeping in mind that they also have the opportunity to lose money, and that's money that you should not be setting aside for income. So I do agree with your strategy. I think it's easy to just say, well, this strategy got me here, I'm sure it'll get me through retirement, but it's not true. When you're in a growth phase, you're not using that money. It doesn't matter if it's going up or down. When you're in the income phase, it does matter, because volatility will ruin a retirement plan every time that stock goes down, and you're taking money out of those accounts on a down month or a down year or a down day. You're locking in a loss, which could have been a locked-in gain. So principal protection is key for income. If you make 4 or 5% on a principal protected account, it will last longer than the stock market. If we go the last 20 years repeated, if we go 20 years ago or 24 years ago, let's go back to 2000 and start off on a bad note, because the stock market was really high in 2000, just like it is right now, as far as pricing goes, and as far as price earnings goes, and as far as just historical, rate of what we're willing to pay for a piece of stock, a piece of a company, kind of almost unprecedented. So let's go back to that time, that we're in a time very similar to where we're in right now. And let's forecast over the next 24, 25 years. You will run out of money probably in about 14 to 16 years if you put it all in the stock market, and you will not run out of money if you make even 3 or 4%. And you'll probably still have 3/4 of your balance left in 17 or 18 or 20 years when you would have run out of money in a more risky investment. So you can actually put the ups and downs and the gains and the losses of the S&P 500 in one column, and put a principal protected account that makes 6% on its best years and makes 0 on its worst years, and just look at what that would have done. Believe me, you would have a lot more money in your 80s and 90s than you will if you put it in the market.
Michael, we're of like minds. We appreciate you listening to us there in Sahuarita, and of course we'll send you out Jeff's book, Retirement: The Road Ahead. Jeff, next question comes from Lloyd, who's listening to us in Barrio Viejo, and he writes, I recently received an inherited IRA and Roth IRA from my mother's passing, worth about $300,000 in total. My understanding is that I have to distribute these assets within 10 years. What are some general recommendations for this withdrawal?
My general recommendation would be, let's try to pay the least amount of taxes on those withdrawals as you can. And that might mean that you take if you just retired and you haven't started Social Security yet and you're living on savings, it might mean that you take $150,000 out of it this year and next year and get a tax bracket of 22% on it and be done with it, and reinvest it in something that could actually create tax-free cash flow for the rest of your life. It also might mean that if you're working right now and you're making $200,000 a year, the last thing you want to do is enhance your 24% or higher tax bracket coming up in the next year or two. By taking extra money out. But if you plan on retiring, let's say 5 years down the road, and maybe can wait, because I don't even know how old you are, but if you're retiring a few years down the road, it might be smart to just take those funds out over the next 5 years, which will still get you divested within the 10-year period that you need to take the money out, still get some tax deferred or tax-free growth on it while you wait in the first 5 years of the 10-year period. Then maybe on the next 10-year period, maybe you have $400,000 in there, and you take $40,000, or let's say you take $80,000 a year for the next 5 years, and use that to live on, and still pay tax at maybe a 15 or 20% tax bracket rather than a 28 or 30% tax bracket that you would pay if you lump summed it out. But they are getting a little bit more picky on how you take the money out. I think the IRS wants to capture some of that extra tax money that they feel is available to them by these accelerated withdrawal provisions that they've just instituted in the last few years through the Secure Act. The COVID deal changed some things, and it sounded like they were being really benevolent to us by letting us wait longer to take IRAs and, do different, strategies for retirement planning. But this inherited IRA being squeezed down to a 10-year payout is kind of stinky, especially when you think Roth IRAs. By the way, the Roth IRA, I don't know how much is in it. I kind of, answered that question if it was all potentially in the regular IRA. But, the Roth obviously isn't going to be taxable. I would, let that grow to the highest amount possible and have that possibly be the last money you take out of that. And again, this just depends on your whole situation, what your income is, what your needs are, what your emergency, provisions are, and so forth. What other planning you've done and how comprehensive it's been. Maybe you haven't had any comprehensive planning. Maybe this is the first money you ever got. I don't know. Maybe you have millions of dollars in savings. This is nothing. But bottom line, in the context of your overall planning, you want to get as much tax-free growth as you can and tax-free income as you can. So probably deferring that Roth IRA is smart. using that IRA in increments where you pay the least amount of taxes, whether it's now because taxes are at a lower rate than they will be in a couple of years due to the Trump tax cuts going away if he doesn't get reelected or doesn't get elected this time, then I think those tax cuts are going to be gone probably forever, and there's going to be worse taxes ahead. So it might be smart to divest that IRA money earlier, depending on. Again, it's all about paying the least amount of taxes, in my opinion, because you can reinvest in another account somewhere else that's not in an IRA, that's not restricted and not forces you to take money out and make similar returns probably than what's available to you in the IRA and the Roth IRA accounts now.
Lloyd, that's a pretty good question. Thank you for listening to us and sending it in to us. Of course, we'll send you out Jeff's book, Retirement, The Road Ahead. If you've got a question you'd like us to answer on the air, quite simple to get it to us. You can call it in to Shelley, 520-780-9059. You can also go to our website, premret.com, ask it in the contact page there. And if we use your question on the air, of course, you'll not only get a great answer, but you'll get Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, no cost, no obligation for our retirement roadmap. You can get it by calling 520-780-9059. You can also request it online at premret.com. Jeff, we do get many questions here at the radio show, and one that is asked very often when we have meetings, I'm going to say a little less than half the time, quite a lot, is whether or not we should pay off our mortgage or invest the money. You know, deciding where to put your hard-earned money, it's often a complicated decision, but it's especially true when you're considering paying off your mortgage early. And while owning a home outright, it's a common aspiration. It may be more beneficial to invest the extra cash in the markets instead. So let's cover some of the reasons why it would be better off to pay off your mortgage early. What do you think is number one?
For the reason to pay off your mortgage early, depending on what your rate is, it just depends what your opportunity cost is. If you're paying 7% on your mortgage, I think it's probably a good thing to get out of when you could, just reinvest your money, not have that outflow, and get a little bit of peace of mind. I think peace of mind is probably the only reason I would pay off a mortgage. I'm a believer in mortgages. I mean, I like having, my money working for me in other areas. I can make more on my money than the mortgage cost me. All my mortgages are 3 and under, so. I'm happy to pay that in interest and load up my mortgage against the equity and loan my money out for other things, whether it be, government bonds, corporate bonds, personal loans, real estate loans, stock market, long-term stock market investments, diversified portfolio of bonds and, gold and other things. But it just kind of depends on your situation. Like I said, I am not necessarily in favor of paying off a mortgage. I think you can invest. The thing is a mortgage, and I'll tell you why this thought process has been kind of confirmed in my mind in a second. But if you have a mortgage, you have equity in a house. If you get sick, you can't just go and write a check against it unless you already have an open line of credit or something. If you have already taken the equity out of your house and it's sitting somewhere in an investment, let's say it's at Fidelity or your bank and CDs or wherever it is, and you've got this cash flow issue, maybe you're paying $2,000 a month on your mortgage, but you're making $7,000 or $8,000 a month to cover all your bills, so there's enough extra to have some fun and pay your living expenses. But you still have a few $100,000 in the bank that you could get, given something bad happens. My dad had a stroke. I'll tell you my story of why it's been reconfirmed in my mind why it makes sense. Because cash and access to cash and liquidity is absolute king. It doesn't matter what your net worth is. It doesn't matter what your home equity is. My parents lived in a house in California. They paid like $15,000 for it back in the 60s, and it was worth about $450,000 when my dad got sick, and this was 30 years ago. And he was a school teacher, planning on retiring in a few years, and they were trying to pay off their mortgage and get out of debt. Paid off everything so that they could retire absolutely, debt free and have the entire pension to spend on a monthly basis, which would have made ends meet. Turned out he had a stroke, ended up with cancer, ended up dying before he ended up with his 30-year full retirement, didn't get the whole package. Yeah, they didn't have any debt, but guess what? They had no cash. When it was time for my dad to have care, mom had to do it all. She couldn't go out and get a job and earn money. That would have actually padded the savings account and been better for the family. But it turned out that, without any money, her hands were tied. There was really no options to, send him to a nursing home where he could have got better care in the last final couple of years. But if you're going to spend down all your cash just to pay off a mortgage, I think it's ridiculous. You need some cash. Balance that off. If you just have a peace of mind issue and you want to pay it off because that's what you've always believed and that's a goal of yours, fine. It's, I'm going to change your value system. But if you want to let the math, help answer those questions, I have no problem with, basically using the equity to live on. It doesn't have to be a reverse mortgage where you actually take money out. But, there are some people that actually will do a reverse mortgage rather than paying out of their own savings and IRA money to pay off their mortgage. You could actually do which is, by the way, taxable when you pull it out of IRAs and 401ks to pay that off. So it ends up costing you about, 40 or 50% more to pay off your mortgage than it would have if you just borrowed the money from either a reverse mortgage. Well, you could do a reverse mortgage, have them get rid of your regular mortgage, have that little loan accrue while you're alive, but not cause you any cash flow problems. When you die, it just comes out of the balance of the account. If you borrowed $100,000 to pay off your mortgage, and when you die, you owe $150,000 to the bank because they loaned you that money way back when, but you didn't have a $2,000 mortgage payment for, 25 or 30 years. And when you died, your house, instead of being worth $400,000, is now worth $1 million. I mean, you've still got $700,000 or $800,000 in net equity after sales, fix-its, or whatever the kids might have to do to that house and and still get the equity. So again, I'm not really a pay off your mortgage type of a guy, at least not with your own savings. At least, I like having liquidity available because I've just seen too many situations where people, as they age, come into a place where they need the money. And I've got a client right now that I think she's called probably 6 times in the last 10 weeks for money because she broke her knee, she hurt her hip, she's got some rehab, and she's blowing through her savings. And our original plan was for her to do a cash out reverse mortgage to basically keep about $400,000 in cash in the bank. In fact, so she decided instead to write a check and pay for the house cash. Now she's too sick to get the mortgage. She's too sick to borrow against it. She's using up all her liquid cash and it's going fast because of this unexpected experience. And I don't know if she'll have time to get that money out if she gets well enough to to fix it and maybe reconsider using that mortgage. By the way, her son is very well off, let's just say. So well off, it blows your mind. So she doesn't need to leave any money to anybody. I think if you look at, just what do I need in case there's an emergency? Do I have enough cash? Do I have enough liquidity? And is paying off my mortgage really going to enhance my plan, or is it going to hinder my plan?
We're talking about whether or not you should pay off your mortgage or not. Jeff, what do you say to those people who say, well, I don't want to lose the tax benefit?
Well, I don't know. What's the tax benefit? You've got a standard deduction of, $28,000, almost $30,000 now. Even when the Trump tax cuts go away, between the exemptions and the standard deduction, I don't know anybody that's paying $14,000 or $15,000. It's really hard to pay that much in interest just to get a tax benefit. By the way, I don't know that that's a reason to pay off or not to pay off. But, if you are getting a benefit because you have other standard deductions, maybe you give a lot of money to charity, maybe you have some tax write-offs for healthcare and so forth, then yeah, you are actually getting a tax benefit. I don't think that it's like the make or break decision. It still has to come down to the final math. If you're paying 3% on your mortgage, like I am on all my mortgages are tax deductible because I blow through the standard deduction every year for, just for charitable contributions, if nothing else. But so I do get a tax write-off on, any of those personal properties, or, you can have up to 2 personal properties that you live in that you can write off and get that tax deduction. So my net rate out of pocket is only like 2%. Okay, that's great. Well, like I said, I make more than that on other money. But even if I didn't have the tax deduction, I'd probably still have the mortgage. That's just me. And that's, generally my viewpoint for clients. But again, if you just have that idea that you want a paid off house because that's been your dream forever, and you just want to have that feeling of, look, I paid down my house, I own nothing, I don't have a mortgage, that's awesome. If you want to be debt free, you're debt averse, well, pay it off. I mean, I'm not going to change that value system. It just doesn't work for me because I override some of my emotions with math, and I let the numbers do the talking for me often. And not everybody does. I get that, but yeah, I wouldn't put all your focus on, is it worth paying off because of the tax benefit? It's just a factor that you want to use inside the equation of whether or not you do it. It has to, benefit you on an overall basis.
Jeff, I'm sure that based on a conversation today that our listeners may have some questions of you, whether it's about paying off your mortgage or not. We're here and available for you to talk to Jeff on a one-on-one basis. 520-780-9059 is the number to call for your retirement roadmap. No cost, no obligation for that, certainly no judgment. You can make that call right now. It's going to take you about 60 seconds or less to do it. Leave your name, telephone number. Shelley will call you back during the week and set up a time that is convenient for you and Jeff. Again, take advantage of this opportunity. We're reaching out to you to answer your questions to put you on a path towards a confident retirement with no cost and no obligation. Once again, our telephone number 520-780-9059. You can also find out more about us online at primrat.com. Jeff, it's been a great show today, and if our listeners have missed any part of it, why don't you join us on our podcast? Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. We got a lot of shows up there. You can simply Google that as well, too, and you can hear this show in its entirety. So for Jeff Vogan, I'm Jeff Shade. Have yourself a great last Saturday of September. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.